Joining me next is Rashaad Tayob. Rashaad is one of the portfolio managers on the Nedgroup Investments Stable Fund. The fund aims to outperform inflation plus 4% over rolling 3-year periods while protecting capital over rolling 12 months. So Rashaad, thank you so much for joining us today.
Thanks, good to be
I
here.
hope you had a good holiday over 2024 and looking forward to 2025.
Indeed.
So 2024 was quite a year, many newsworthy events, some of which impacted the markets quite dramatically. And Ford's investment philosophy is quite conservative. You're really focusing on protecting capital during difficult market times. And over the years, this has worked really well in terms of the long-term performance of the fund. But sometimes it has resulted in a little bit of underperformance against peers. So maybe just to start, you can take us through the performance over the last 12 months, as well as the contributors and detractors over the period.
Of course, Natalie. So 2024 was a positive year in terms of the return, but as you mentioned, we did lag peers by a few percent just over the last year. But if you do look at the medium to longer term, the 3-5 year and longer horizons, we are still delivering very credible performances versus the CPI plus 4 benchmark as well as the peers. So just focusing on 2024, we delivered performance from a range of different asset classes, which is always our intention. We don't want to just have returns from one asset class, which can be quite a risky return profile. So if you look at where the performance came from on the domestic side, local equities did well. We did have more generally the higher quality stocks are what we focus on in the stable fund. In resources, we look for the best counter like a BHP. We look for higher quality names like your Anheuser's and British American Tobacco, some process. So we do focus on those names which have less downside risk for the stable fund. Property delivered some good performance, a relatively low allocation at 4%, but properties did well. And some of the stocks like Fortress and Nepi, we outperformed the benchmark by quite a significant component. And on the local FI side, you had quite a nice bond rally, which we participated in, and that delivered a good performance for the fund, as well as on the money market sides, with yields being relatively attractive. That was also a driver. So that's the domestic component, a bit of return from the different asset classes. On the offshore side, we've had a mix of global equities as well as some other foreign assets, primarily gold. We know gold had a very good year, so that delivered a good amount of performance, even though it was around a 5% allocation. On the foreign side, with the rand weakening towards the end of the year, as well as the performance of global equities, that did deliver a reasonable performance and added to the fund. However, maybe not as much as what we would have hoped for, given the performance of total global equities. The performance of global equities in 2024 was quite narrow, and while we did have some of the names, we didn't have as much as maybe some of the indices and some of the drivers, and our allocation maybe to some of the more conservative areas, some of the Chinese stocks didn't do quite as well. So it did deliver a positive performance, but not as much as we would have hoped.
So having that underweight US and relatively overweight China position, it was quite a notable call for your the offshore components of the fund. And given the massive US rally we saw, it didn't work out as well, as one would have hoped. And even though China had a better run in 2024, it still has quite a long way to go. So how long do you think that the US stock market can sustain this upward growth trajectory that we've seen?
So we've had 2 phenomenal years out of the US market, but we do feel that there are some headwinds going forward. And we do feel that some of this US exceptionalism is built on quite fragile foundation. So when I look at what drove markets in 2024, I think there's 2 key things that why the market and the economy performed better than expected, despite the fact that we went in in 2023 with quite an aggressive rate hiking cycle. So the 2 things are, firstly, the fiscal deficit, the amount that the government is spending. You're talking about a true $2 trillion deficit into an economy which is growing at a reasonable pace. That's quite unusual, the amount of stimulus we're seeing, and that's what's keeping the economy afloat. And then the second thing is you saw in 2024 a further leg up in the big tech stocks. So they went into the beginning of the year reasonably, I think, overvalued, but we still saw this continued AI boom and the hype around AI accelerating that further. So if you look at the chart on the right, in the fourth quarter, the returns from the S&P 500 were primarily delivered by these big names, the Microsofts, the Nvidias, the Googles, etc. So that market rally is quite narrow, and now that a lot of positivity and almost hype is being priced in, while we do think there is long-term potential from AI, the amounts that are being spent in terms of capex, it's uncertain whether the valuations are sustainable and whether they are going to get a return on them. So we're happy to be conservative on that front.
I just saw quite a funny quote when I was reading about this, about the US spending, that I wanted to read to you. So it says, to say the US government is spending money like a drunken sailor would be an insult to drunken sailors who at least A, spend their own money, and B, quit when they run out of funds. I thought you might appreciate that. So what does the bond market have to say about all of this? Does it also agree that the US is looking like it's heading into unsustainable territory?
I think unfortunately the governments around the world, and especially the US, got into this habit of overspending during COVID massively, and they're just struggling to break that habit. And I think the second half of last year was when you saw the first signs that the bond market is beginning to get a bit upset about the amount of spending and the lack of constraint. If I look back at the history of the US, there's always been politicians concerned about the deficit, about they've got that debt clock in Times Square. So it's always been an issue about big government. But we think on both sides, whether you're Republican or Democrat now, they're both into this habit and they just want to spend as much as possible and juice the economy. So that is a concern. And when you look at the chart here shows the reaction of the US 10-year bond after the rate cutting cycle started in the middle of the year. And generally, when you see the Fed beginning to start cut rates and the beginning of the cycle, it's a great time to buy bonds because that's when the rally starts and it continues as you enter a rate cutting cycle. But this time, bonds actually sold off after the Fed started cutting rates. And that is a very strange phenomenon. And a lot of that is due to the fact that I think there's a lot of concern around the market, how sustainable this level of spending is and how much supply of bonds that are going into the market. So we do think that there are signs building that the market is struggling to digest this US debt problem.
And what about the Trump effect of it all? Seems like the world is bracing itself for what's to come, and I'm sure countries like China and Mexico are feeling quite worried about the policies that he may be putting in place. Realistically, how easy is it going to be for him to make America great again in his second term?
So I think it's going to be quite difficult for Trump to replicate the growth success of his first term. We know in terms of his personality, how he runs his property companies, his businesses, it's all about borrowing money, juicing growth, getting a lot of hype going. And he was successful in his first term, but the circumstances now are quite different. If you look at where the S&P 500 is, was sitting around 2,000, it's now close to 6,000. Look at where the average house prices were in his first term. They now more than doubled. So asset prices have already been moved up a lot. If you look at what he did on taxes in order to boost growth, you see he took down the corporate tax rate from 35 down to 21%. The marginal tax rate came down a bit. He's now talking about taking corporate tax rates from 21 to 15, which would be amongst the lowest in the world. I don't know whether he's going to get that through. And we already talked about the deficit problem. So to cut taxes from here is going to be quite difficult. He's also inheriting the spending problem, where last time he took over, the deficit was only 3%. He then pushed that higher by trying to spend a lot. He's now taking it over with a 6 to 7% deficit. How much more can he really borrow and spend? So the circumstances and the hand that he's being dealt now is quite different. He can't necessarily run the same playbook. And I think that's why you're seeing him run you're seeing this big focus on tariffs. And that's where China, Mexico, and even Canada are getting roped in terms of being a problem for the US economy, because he sees that as a way to raise money to fund this deficit and also get more of the growth back into the country. So you're seeing a realization that maybe he can't run the same playbook, and maybe the growth boost that we saw in the first Trump term is not necessarily going to be replicated. And we're quite cautious on that. We think growth could disappoint.
Very interesting perspective. It'll be interesting to see how that all plays out, actually. So I guess the big question is, where are you seeing value right now? The stable fund has such a broad universe, it can invest in so many different areas. So hopefully there are some good opportunities out there that you're seeing.
Yeah, so if I could highlight a few of them, let's start on the local side. On the domestic side, we had a reasonably good allocation to nominal bonds last year. We saw a strong rally, and we already in the second half of the year started reallocating, trimming that, moving more into money market, and also moving more into inflation-linked bonds, where you're getting a real yield and then you add inflation to that. And the real yield that you're getting has moved up substantially in recent years. So now we're getting real yields of close to 5%, which we haven't seen, for almost 20 years. And we do think it's an attractive place with a asymmetric return profile. If inflation's around 5%, that's going to deliver a 10% return. If inflation potentially is higher because of the debt issues, it gives us even an upside participation. So we like that return profile, and we like the upside participation potential on inflation-linked bonds. Another asset we still have an allocation to domestic equities. We're still finding some opportunities there now. But if you look at the PE of the mid caps, which is representative of SA Inc., you can see what a strong bounce we've had post the election, where we had a positive GNU outcome. So we do think that the easy money has been made, but there are still good opportunities. And if the GNU holds over the course of the year, as it continues to do, if we continue to see incrementally positive policy steps, we do think that getting back to a reasonable growth level in South Africa after such a bad decade and a half could still be positive for SA stocks. And then on the offshore side, we've talked about the issues and the narrowness and the expensiveness of the SA market. On the left-hand side, you're just seeing the relative pricing of the US equities versus global equities, and that gives you a strong indication that there's better potential value outside of the US. This bubble being driven by the Magnificent Seven, which admittedly are great companies, but any good story can be taken too far. On the right-hand side, you're seeing the relative PEs of the S&P versus outside of the US, and you are paying a lot more for US stocks in general. And as I mentioned, the growth of the US, especially coming in 2024, was really driven by these two factors, and I think they are going to struggle to maintain that momentum of growth going forward.
Thanks. So to pull this all together, can you highlight the positioning of the fund, based on what you're seeing in the market and your views, and maybe just end off by sharing a few of your key messages for our clients that are joining us today?
Sure. So on the whole, the structure of the fund has been tilted to be a little bit more conservative. So we had a good rally in bonds. We've trimmed some of that by moving a bit more into money market and moving a bit more into inflation-linked bonds. We've trimmed some of the property. We did well. Some of the equities which have rallied quite strongly, and so we've adopted a little bit more cautious approach, a little bit more cash, waiting for a potential risk-off opportunity that we think could materialize. On the offshore side, the structures remained mostly unchanged. We like offshore allocation from a risk return perspective, the opportunities we see there, and we are close to that 45% or maximum offshore level, which we think does serve investors well over the longer term. So overall, we do think that the risks are building as global bond yields are rising, creating a little bit of an opportunity. We think that equities outside the US are cheap, particularly in China. We've had some false starts before. We had rallies which have fizzled out, but we do think that there are good opportunities there. And if you look at Chinese GDP and spending data, which came out this week, it was all higher than anticipated. And we do think that there is potential. The Chinese manufacturing machine is still doing very well. And if you look at their exports, it's still the big powerhouse of the world. On the South African side, we think valuations are reasonable. The easy money's been made, but we do think there's potential as reforms come through. But we can't count out the potential downside. We've lived through too much turmoil to say there's no downside risk, and the GNU is going to be here for another decade. So a moderate allocation to fixed income. Especially we like inflation-linked bonds. We think the money market yields are still attractive. And we still like gold as an uncorrelated asset. It has served us well last year, performing well, even especially during risk-off environments. And we do think it's going to be a good holding for the longer term.
Great. Thanks so much, Rashaad. We really appreciate you giving us your time today and all your views on the world. It's always interesting, and 2025 looks like it's going to be a very exciting year. So let's see what's to come.
Yeah, we're looking forward to it.